Hello, everyone. This is Calvin Russell, CEO and founder of 850 Club Credit Consultation. Hope everyone's doing well today. So, if you haven't heard the news, Wells Fargo is getting rid of their personal lines of credit. Okay. So now you probably want to know how this affects people and how quick bank changes like this could affect you going forward. Okay. So, first off, let's talk about a personal line of credit versus a credit card. So, a credit card, you guys know the differences, right? You get a credit card, you have a limit. Whatever you swipe, you pay a certain percentage back. Usually, it's a very small amount, but it's usually the smallest percentage, usually around about 1% or so, or that could be $25 or less, depending on what the balance is, and you just keep paying on that. Whatever the remaining balance is, you pay interest on. In some cases, if you pay the remaining balance before the 30-day time frame, there will be no interest. Depending on what your credit card agreement is, you may have interest anyway, whether you pay it off early. That's a traditional credit card. We're used to that. Personal line of credit is a little bit different. This one, you kind of works on a draw system. So you still have not necessarily kind of like a limit, but then you take money out of it. And then, of course, you have to pay this certain amount back. Now, with personal lines of credit, it just really depends on your terms. Some of them have 12-month terms. Some of them have 24-month terms. Some have very similar terms, very similar to credit cards. But these are for people who are always kind of, taking money out, putting money in, taking money out, putting money in. Not like, lunch here, movie there, a pair of shoes here, like a credit card. A line of credit is usually a larger amount, usually over 5,000, over 10,000, just really depends. But either way, Wells Fargo realized that a lot of people are not necessarily using line of credits like they used to. Usually, a lot of people that are business owners usually do it. That said, they said, okay, we're just going to go ahead and close all of the lines of credit. Here's the problem. Lines of credit do not show up like credit cards. Credit cards show up as revolving accounts, right? So revolving accounts are based on the percentage that you use. As we know, utilization, right? The utilization percentage. So for example, with a credit card, the limit can be 1,000, your balance is 300. That's a 30% utilization, okay? So now the flip side is with a line of credit, that shows up like a personal loan, okay? And with a personal loan, obviously, if the limit is, let's say 20,000, you draw out, 10,000, and then you're making payments on that until it's paid off. It shows up like a personal loan. So for those who don't know, anything that's a loan, personal loan, auto loan, mortgage loan, student loan, anytime a loan is paid off early or closed before the term date, can drop your score. So that's what the big kerfuffle is. I think that's it. I don't know. You guys, you guys got the college degrees, right? So, but again, that's what seems to be the issue. It's so much of an issue that Elizabeth Warren has given her 2 cents on the matter as well too, and saying that not one Wells Fargo consumer should be seeing any I was about to say a price drop, any score drops, and which she's 1,000% right. But the problem is that this is actually a smaller situation than what happens in the mortgage industry. In the mortgage industry, mortgage companies can sell your mortgage loan at any time. And when they do that, that pays off the other loan, which drops your score. And then now you have a new loan, which can sometimes drop your score additional points. So just kind of keep that in mind. It kind of sucks to kind of see that. But the fact that Wells Fargo is telling us what's going on is honestly a step above what happens with mortgages. I myself, my mortgage got bought out by another company. The secondary mortgage industry is huge. It has nothing to do with income, credit. It happens to everybody. You can have stellar credit, phenomenal terms. They're still going to honor those terms. The problem is that someone else buys it out. You can't stop that industry. There's nothing you can do about that. It's the algorithm that when a loan gets paid early, it can potentially drop your score. And in this case, it's not even being sold. It's just being closed out and you have to pay it. Just like in the Midwest, we have a store called CarSense. Or you can go on a more national level, Toys R Us. So if you had a Toys R Us card, Babies R Us, credit card, you had a balance by the time that they closed out and went out of business. Then they just closed out the account. That dropped a lot of people's scores. And you still were responsible for the balances, of course, because they expected that money to be paid. The same thing's going to happen with the Wells Fargo line of credits. Long story short, it's more than likely going to drop your score. Is there something you could do about it? It really sucks because it just goes to show you how these banks, and I think really I'm honestly thinking that they're not really trying to do this to kind of hurt consumers, but because it's not really their fault in a sense where it's really the algorithm. The algorithm is really what's going to tank the score. Unfortunately. So we'll see how this whole thing pans out. But it's, again, this is major. To see that the world of credit is even in the conversation nowadays. That the world of credit, people are standing up for it. I mean, people really didn't have a voice. Just like we kind of come to YouTube and kind of get what people think about certain things, right? But at the same time, I mean, this is honestly major news that senators are getting behind what's going on. But this stuff has been going on for years. But now that they publicly announced it, so either way, we're going to see how this whole thing pans out. But of course, this only affects you if you're a Wells Fargo client with a line of credit that was open with a balance. So if you had a line of credit and it wasn't really being used, it was closed already, you may or may not be affected. But if you had a line of credit and it had a balance, you were paying order, you are still responsible for that account. It's just being closed. You can no longer use it. That's what it seems to be the case. But there's about a good 80% chance your score is going to see a hit. How much of a hit? We don't know. All right. So, of course, if you like this video, like it. You want to share it. And as always, be sure to subscribe as we have nothing but great content on the way. Thank you all so much. Have a great day.